And Scott said the upcoming United States Supreme Court tariff ruling could be a big market mover for the tariffs, against the tariffs, however they're going to vote, or even if they can do anything about it. Now, with that means market volatility and an expectation of a shift in volatility. And we have various webinars on market hedges, using the VIX, using volatility ETFs, using volatility indexes. So Scott wants to know, I was thinking about hedging with VIX calls, something that we do. From your past discussions, I know you like to look 45 to 60 days out. Is this a case where closer in calls may be a good idea, as the decision is very likely coming out soon? I know this means taking a hit on time decay, but I'm not expecting to hold them long. He goes on to say, second part of the question, would it make sense to buy some calls closer to your standard criteria as a real hedge? And then maybe some further out of the money options, out in time, and further out of the money near-term calls as more of a lottery play in case the market tanks hard. Because if the market falls, the VIX calls are going to go up, volatility is going to increase across the market. And VIX calls, it's another way to make a hedge. You could just simply buy puts on SPY, puts on QQQ, if that represents a larger portion of your portfolio. But the VIX calls are something we like to do in certain scenarios. He says, obviously with funds that I use for such a purpose. What he means by that is that normally I'm only going to allocate maybe, 2, 3, 4, 5% of my portfolio on VIX calls as a market hedge in certain situations. And that's mainly to protect the 15% of my portfolio that I have in leverage spreads, such as bull put credit spreads, the 10% or so I have in longer term calendar spreads on stocks that I don't or can't really, well, I can, but I don't really want to afford to do as a married put position because I don't want to buy the shares of stock on those $700, $800, $900 stock positions. I'm going to treat that as a calendar spread. Poor man's covered call, if you will. Or even if you've got debit spreads or other leverage spread trades, that's where the VIX comes in. Or again, just puts on SPY or QQQ. Now, I didn't answer Scott via email because I was putting this together. I didn't get as far as I wanted with everything going on with the end of the year bonus offer, of course, but the initial thoughts on this. What is the review? When are we going to buy calls in the VIX? Initially, we will look to buy calls in the VIX when we see the VIX, the volatility index, drop below $15 or $14. I say because I don't think I've seen it below 14 in a long, long time. Ernie's preference is actually look to around 16 now. He's a little bit more aggressive. He looks to buy calls in the VIX when it's around 16. And when we see the market sentiment tools start flashing the sell warnings, or even, I didn't put this in as a bullet point, but even as Scott said, if I know that there's a known event, a big known event with an unknown outcome coming up, and the VIX option, VIX is around 16, is around 15, somewhere in that range, but this outcome could do something, that's a good time as well. So we're going to look to add an extra hedge for our leverage positions. Typically, we go 45 days or so out in time, as Scott mentioned, and I typically look for the calls with a delta of 0.3. Now, you can see more in-depth ideas on these concepts and other comparisons against other market hedges going to our YouTube playlist, our Power Options YouTube channel. Click on the playlist, and there's one there for market hedges, for unexpected events, and much, much more. 9 videos. Some are comparisons on using bear put debit spreads on SPY or QQQ compared against buying calls on the VIX and just puts on SPY or puts on QQQ. So you can see all of that there. All right. Now, other concepts related to Scott's question that I thought about. Now, laddering is a good concept. The idea of laddering that he mentioned, his was almost a reverse ladder, but I get it. But laddering is a common concept, and it's a good concept to use for covered call trading and even long call buyers, conversations I've had since I started working with Power Options over 20 years ago. And the covered call idea, I buy 500 shares of stock, let's just be simple, at $100. I'm bullish on the stock. So I might sell one call for the current or near expiration right at the money and get a good time value, get a good at the money bell curve time value. But then, or I might sell 2. Let's say I sell 2. Can I collect $1? But then I go the next expiration cycle out, or maybe 2 expiration cycles out if it is weeklies, and instead of selling the 100, I sell the 105. But I'm selling 2 of them. So I'm getting 80 cents, 90 cents, almost a dollar, but between it too. And then I sell 2 more calls for the next cycle out, or 2 weeks, or 2 cycles out if it has weekly. So for a full month out at the 110 strike. Laddering covered calls. So if the stock exceeds my expectations, I may get assigned on those first 100 or 200 shares. And then 15 or 14 days later, I may get assigned at that higher strike price if the stock continues to move as I want, and then still sell calls or buy more shares and do that. So laddering is an approach with the covered call strategy. It's not complex, but it's a little bit more extra work. And this is also done with long calls. So I buy a call. How Ernie approaches it, I should say. Ernie might buy 10 to 15 calls on a stock that had a Bollinger Band breakout on our default power option search for long calls, our preferred search, a Bollinger Band breakout, looking for things that have just broken out that we expect to increase in price. And he might buy, as I mentioned, 10 or 15 calls. But then if the stock continues to move up, he might sell 3 or 4, maybe even 5 of the calls that took a profit and buy higher strike calls further out in time. I say, hey, if it keeps going up, what have I got to lose? I've cut down some of my total exposure and costs in this, and doing it that way. Management techniques rather than straight laddering. But laddering is popular with the covered calls, and I have talked to investors through coaching sessions that do it with the long calls as well, Scott. But there are other things to consider with this particular underlying security in this particular approach. VIX options are not priced and based the same way that standard options are. Yes, you can consider it intrinsic value, and yes, you can consider it extrinsic value or time value. But the VIX options are based on the volatility futures out in time. They're not based on a straight intrinsic value. What I mean by that is very rarely will you see an in-the-money VIX option that is below intrinsic value in the times and the markets that we're looking at right now. But I've seen it in the past. Years and years ago when the VIX was just hovering around 9 and 10. It didn't break out of that range. 11 was scary. You saw it go to 11, things were bad. But it hovered around 8, 9, and 10. VIX is trading at 9. The 8 strike call, and this was before weeklies and before the Monday, Wednesday, Friday expirations of the VIX and everything along those lines, the VIX would be at 10, or it would be at 9. Let's say it's at 9. The 8 strike call would be worth 50 cents. Because 3 months out, 2 months out on the VIX futures, they expected the volatility to be lower. It was below what you would think is intrinsic value. We haven't seen that recently, but that has happened. And that's been interesting. Now, the approach of laddering is similar to the approach that I use, but in a different aspect, meaning that when we use VIX calls, I do. Ernie has a different management technique. You're going to see all this next year. You're going to see our VIX product on how we trade the VIX, when we trade the VIX, management ideas, and much, much more into 2026. But when I use VIX calls, I usually buy around 8 contracts following these concepts that I mentioned. 45 days or so out in time, 0.3 delta, and it usually is around 8 or 9 contracts. Or 8 or 10. I try to keep it an even number. Why? Because when that first break happens on the volatility index, I'm going to sell half the calls in the first move. I'm going to close 4. Let's say it's 8. Now, I'm going to close another half, usually what you see, quick movement. When you see a jump in the VIX, usually 2 or 3 days later, it's back down 50% from the jump. And usually 5 or 6 days later, it's back down to where it was before the jump. So if it pulls back, I'll close another 2. But then as Scott mentioned, hey, there's usually sometimes another jump that happens, and usually gap, and it's like, hey, okay, it wasn't as bad as we thought. It settles down, but oh, no, there's these other ideas, and it jumps back up. So then I sell that other half. I close one of the last 2 at that move. And then when it starts to pull back again, that's when I close the last one. This, in effect, is similar to the laddering concept, where instead of having a couple of options near term, with my criteria, as Scott mentioned, and then going out or closer in and buying another 0.3 delta, which would be a lower strike price, or buying another one and just having them staggered for different expirations and different strikes, the management I use that is kind of simulating that as well. It's almost equivalent to that same approach, Scott. And we're going to take a look at that if we can in just a moment. But first, I wanted to discuss this concept a little bit more. What do I mean by it's based on the futures? What I mean by that is that just looking, we ran before the presentation, of course, I ran a power option search for VIX calls that were just at between the strike price, I'm sorry, Scott, of 15.9 to 17, 16.99, I think I did, just to isolate the 16 strikes. And we see what we would expect, and then we see something we suddenly would not expect. These are all 16 strikes. The VIX is at 15.05. It was down 182 today. It's in the buy range, as we mentioned, that 15 to 14 range. It's getting down there to where we look to buy it. All right, but shorter term, what do we expect here? Okay, so the 0.27 and 0.36 deltas for our next expirations, the 24th, 5 days away next Wednesday, it's at 55 cents. Got a reasonable implied volatility of 1.3 based on where the market's been and concepts. The 31st of December is at 149. All right, that's almost 3 times the cost, right? That seems like a lot for only a 7-day increase, not even double the days to expiration. It's 3 times the increase. And here, 19 days out in time, the 7th of January expiration, we're about 4 times. So we've got about 3 times here. We've got about 4 times the price of the near term here. Volatilities are increasing. Implied volatilities are increasing. Deltas are increasing too, as we'd expect. But then suddenly, the next 7 days out, our Wednesday expiration for the 14th of January is only 217. That's still about the same 4 times the amount of cost of that near-term 5-day out option, and it's only 3 cents higher than the January 7th 16 call. And now what happens on the 21st of January? Same strike, 16. It's at 207. It's lower than the 2 previous expirations on January 7th and January 14th. What is the target that's going on here? Why are these options more inflated and have the higher implied volatility? And then further out in time, 1650 strike. Okay, so it's not the same strike, but it's 1650. It's at 185. That's still only about 3.4, 3.5 times the 5-day out option. This is the way that the options are priced. It doesn't work the same as a standard option chain because it's based on futures pricing. What other things can we see on this simple chain view on power options, just isolating VIX calls, to tell us something weird is going on in this January 7th to January 14th timeframe, and also the near-term timeframe with that 0.3 delta I mentioned that Scott referred to, the open interest. Today's current option volume and open interest on the 24th of December 16 call could have been more management, could have been movement from last week's series, but why do it on Friday with the Wednesday expiration series we have with the VIX? But something happened today where there were a fair amount of bets here. The open interest is going to jump up to 7,000. It's almost going to double from what it was. This is the current open interest based on the closing prices on Thursday, or the closing values, exchanges on Thursday. And today's current option volume is 33.79. When the market updates, we're going to see this open interest go up to about 7,500, 7,600. It's quite interesting. And here, the 16 strike for the 21st of January has an open interest of 6,300 already. 1,400 here. the volume and open interest on our 31st of December, 7th of January, 14th of January are almost a 10th to a 15th of what we see for next Wednesday's VIX cycle and the cycle on January 21st. Something Ernie and I always watch is when we see a high open interest. And again, this one here, the price is lower than the nearer term. You always expect, hey, if I'm going farther out in time, I'm going to pay a higher price for the same strike. This 21st of January price is lower. So what does that mean? Hey, I bet is a bad term. I'm sorry. I'm looking to hedge, as Scott is, and I'm saying to myself, okay, I'm going to follow this 0.3 delta rule that Mike kind of uses. I'm going to go shorter term, and I'm going to ladder my positions. And I'm seeing increased prices, which is natural with any options trading cycle. Why would I go 40, 50, 60 days out in time or further when I can just buy short term because I think the event's coming up here? And you see it in the pricing. These are actually cheaper. Now, of course, when the event happens, the futures, VIX, the volatility futures, are going to change too. So you might see these prices change by a benefit of an increase in implied volatility or an increase in implied volatility. But this is not the same as trading a standard stock change and comparing against pricing of, oh, it always has to increase as we go further out in time, because no, it doesn't. Because it's based on the futures and where the futures are set, not on intrinsic versus extrinsic. Now, yes, these are all inflated. These are all extrinsic value because we look for that out of the money 15, 16 strike call and so forth. But if you looked at just the at the money 15 strikes right now, you'd see a similar thing. The prices to purchase the 21st of January 16 call, the 21st of January 15 call on the VIX would be lower than the 15 strikes for the 14th expiration, the 7th expiration. And yeah, that's what you would see. So that's always something that I have to consider, and always something. Now, hey, Mike, what about the 0.3 deltas? You're comparing different deltas here. Of course, they're all the same strike. I'm seeing that. That's kind of interesting. But what about everything that's at a 0.3 delta that you say you buy? How is that affected? Again, this time we changed the power option search. Instead of looking just for VIX calls, sorry about that, 40 to 55 days out, and I'm sorry, 5 to 55 days out in time at the same strike. What if we use the delta? So I isolated the delta between 0.25 to 0.35, essentially. Now we have the different strikes. But at those deltas, what do we see here? And we just sort of blatantly blew ourselves out of the water when I saw this. Look, our 16th strike that we came up 55 cents, okay, 0.27 delta, $1.46. Okay, let's call it almost 3 times as much, not quite. And that's the 7th, 17 strike. We saw that the 16th strike was just about 3 times the cost. This is not quite, but it's close. Delta of 0.28. 14th of January, 17, 171. It's only 25 cents higher. Delta is about the same. An extra 7 days for 25 cents. It's interesting, isn't it? And then the delta of 0.3. We go up to the 19 and the 1950 and the 20 strike. Oh God, and the 2050 on 21st of January. And they're less than both of the 7th of January and the 14th of January. Now, this is kind of what he was asking is, can I still make a profit on these with these 17 strikes? If that judgment comes out, it's going to come out before the 7th of January, before the 14th of January, and that could cause the market to spike. But everyone's expecting what? That the market and the volatility is going to settle at some point after that, regardless of what the ruling is. But you're paying for that premium because the market knows what you know. Now, we talked about the 16 strikes, Scott. We talked about it on the last slide, and we saw the open interest in the 4,000s and the 6,000s. Oh my goodness gracious. Look at these open interests on the 1950, 20, 2050 strike calls for the 21st of January. 39,720, 74,550, 97,613, 147,863 open interest on the calls for the January 21st expiration cycle of 2026. Today's volume, 27,641 at the 1950 strike, 57,701 for the January 20 call. Delta's at 0.32, 0.3, 30 to 40 to 50 to 60 days out in time. No, I'm not copying someone else's guidelines. This is just what we saw. And when Ernie and I typically see this, that's when we typically say, hey, it's something, there's money going into these. When you guys talk about, I talk about on coaching sessions with the moneyness in, right? The money coming into stocks. We've seen a recapitulation already. Money's been leaving the AI stocks and it's been going into bank stocks, and we've seen gold and silver and the indexes and those securities be on a tear recently, but the financials have also been on a tear. We're seeing a recapitulation of institutional holdings, a filter that you can use on power options. And when you see that, you just say, oh, someone knows something I don't know. And this is usually when I call Ernie after the webinar, or I send him something, 147,863 at the 21 strike for January 21st. And I don't know if they're buys or sells. These could be spreads, right? Someone could be doing a spread here on this, whether it's a bear call or whether it's a bull call. I don't know. I don't have the values here. We can't get it on power options and exchange thing to see what's sold and what's bought to open on the open interest level. But this here is massive, 147,863 on that 21 strike for January 21st. Priced at 81 cents. Kind of interesting. Lower than the 2050 strike for the same expiration. Lower than the 20 strike for the same expiration, which we expect, right? We're going further out of the money. We expect that. But as we saw in the last slide, if we compared the 21 strike here to the 21 strike of December 24th, January 7th, or January 14th, those 21 strikes are probably higher in price than this one that's further out in time. So it's kind of bang for the buck, Scott, is what we're talking about. Why do we go 33 days out in time? It's because when we look at these chains, we look at these values, then we want to try to pick the target not only that is actually giving us a lower premium than we'd expect when comparing the same strikes, but also where's the moneyness going? Where is the activity? Where are people placing their bets? Doesn't mean they're smarter than us, Scott. Doesn't mean they're dumber than us either. There's some bets going on in here. If you look at the full chain, you might see another strike at the 24 or 25 that's up to 120, 130,000. Again, that might denote spread trades, hedge positions on the VIX, whether they're doing bull call debits, whether they're doing bear call credits as well.